Good afternoon and welcome to today's webinar. Is self-managed super right for you? My name is Caitlin Mutzelberg from CCIQ and I'm your facilitator for today. Alongside me, I am delighted to welcome Chloe Ward, Self-Managed Superfund Specialist and Manager at Superfund Partners. This webinar will provide you with a good understanding of the overviews of the roles and responsibilities of a self-managed superfund trustee, administration requirements of self-managed super funds, main investment restrictions applicable to self-managed super funds, and whether a self-managed super fund is the right choice for you. Superfund Partners will also be holding a self-managed super fund e-workshop on the 19th of October, where you'll be taken through the self-managed super fund options in more detail and walk away with an actual plan on what the best self-managed super fund option is for you. Places are limited, so go to the CCIQ events page to secure your place for the C-workshop. First, some tips to get the most from today's session. We will be online for about 40 minutes, and following the main presentation, there will be an opportunity for questions and answers. Please send through your questions for Chloe using the text box on screen. At the end of the presentation, we will collate all the questions, and Chloe will answer as many as she can. Following the session, we will email all participants a copy of the presentation, a link, and any additional supporting information, so please check your inboxes later today. So now I'll hand over to Chloe Ward from Superfund Partners to take you through today's webinar. Is self-managed super right for you?
Thanks, Caitlin, and thanks everybody for taking the time to register for this event today. I appreciate CCIQ inviting me to be a part of their network and getting some education out there around the practicalities of having your own fund. Hopefully, the time that we have together today, I'll be able to give you some guidance on what's involved with having your own fund and which then may provide you with more clarity on whether a self-managed super fund is something that could possibly be a part of your financial future. I'm going to go through the obligatory disclaimer up on your screen at the moment. Everything I discuss today is of general sort of educational purpose only. None of it is to be taken as specific advice. If you do want to have some specific advice around your circumstance, I would encourage you to get in touch with a specialist or myself. My details will be at the end of this presentation and we can go through things in more detail. So to start off today's webinar, I'll be giving you a quick insight into who I am and who Superfund Partners are, as well as all the items to consider when you're contemplating starting your own fund. I'm also going to be going through things like what will make you a suitable candidate, how to physically set up a fund and all the steps involved in doing so. What your obligations are as a trustee and what the responsibilities of that role entails. I'm also going to cover off on average costs, the type of investments you can have, and the various strategies that can be used to maximise your fund. Hopefully in going through these topics, it will sort of debunk or provide some clarity on things you may have heard in the media or from friends or from colleagues. So to kickstart, I wanted to give you a quick rundown on my background and more importantly who Superfund Partners are and what we represent as a business. I've been in the financial services industry for about 10 to 11 years and I hold my self-managed superfund specialist accreditation, which is with the largest industry advocate, the SMSF Association, as well as being a licensed financial advisor. I've been in hands-on with the accounting and the financial advice parts of SMSFs and have dealt with it facet from setups to wind-ups, estate issues and sort of everything in between. Now Superfund Partners is a special kind of business and it's the largest independent specialist SMSF business in southeast Queensland. We currently look after over 1,000 self-managed super funds and all our work is done here in Australia. We're able to keep all of our work in Australia and the jobs in Australia because we use innovative technologies that provide us with efficient processes rather than outsourcing, which is very important to our business. The team we have in place love what they do. We live and breathe superannuation, and we hope that that's sort of evident in our work and every interaction that we have with our clients or potential clients. So, and what we do is we're not just an administration house. We do provide the financial statements, but we like to concentrate on making sure that the retirement goals of our clients are being able to be met. So let's dive into the information that you all came to hear today. The first point I'm going to talk about is suitability, and this looks at what makes someone a good candidate to become a trustee of their own self-managed super fund. So over the years, there's been lots of people that have come out in the media with differing views on how much you need to have a fund. So that's, you know, what the minimum balance needs to be, how old you should be, what investments are best. My philosophy around this is pretty simple. We start with the basics. Is your financial house in order? One of the first questions I ask clients is, are your personal tax returns up to date? Secondly, what's your personal financial situation like? Do you have massive personal debts? Do you know what your debts are? Or do you know what your financial situation looks like? I see a lot of clients that come in where one of the partners will know exactly what's going on in their financial lives and one partner that won't. This is a bit of a red flag for me, as it's really important that all trustees have a grasp on what they're getting involved with. So to build on that, the next question is, do you have a level of financial literacy that's going to enable you to understand what's happening in your fund? So this is not to say you need to know all the tricky tax jargon that accountants and advisors can throw around sometimes, but more dealing with the fundamental understanding of what your financial statements represent, you know, or even what are equities, knowing what managed funds and fixed interest is. And look, if some of these terms are foreign to you, then a real willingness to learn or seek advice when needed is a crucial aspect of running your own fund. So the next point we have is the current balance. Now, whilst there isn't a mandated current balance to start a fund, there definitely are guidelines that ASIC have recently refined. So ASIC have basically come out and they've said that anyone with a balance below 200,000 should seek advice on sort of like the cost effectiveness and the suitability of a fund. So from my side of the table, this means that I would need to prepare formal advice for someone wanting to set up a fund with this type of balance. In no way does it mean that if you have a balance under 200,000 that you shouldn't have a fund. It's just that economies of scale are really at play with the fund, with the fee structures for super and having your own self-managed super fund, and it can have a large impact on the overall performance of your fund, and that's why the guidelines have come out saying that formal advice should be looked into to make sure that it's right for you. Another suitability criteria is time. A core data report recently said that the time it takes to run a fund is approximately 40 hours per annum. Now, while I think this is probably a little bit excessive and is probably largely dependent upon the administrator or the accountant you're using, there is going to be the need for you to attend to Superfund matters, and they might be things like providing statements to your accountant or administrator, signing end-of-year paperwork, spending time making investment decisions, which is what we would hope you would be spending most of your time doing anyway. In my experience, getting a good administrator or accountant on board who can handle a lot of this process-orientated paperwork will cut this time down for you. But time definitely is a factor to be aware of. Okay, so setting up an SMSF. Once we establish the suitability of, candidates, the next stage really is the physical setup. And the number one question we ask at the setup stage is, do you need that advice? So going back to, if you have under the $200,000 mark, you would suggest that yes, you are going to need advice around that. Those with a balance over 200,000, some people have done the research and have quite a bit of knowledge around super, and they feel very comfortable in making the decision to start a fund. Others may even though they have over a $200,000 balance, may want to compare their retail or industry fund with a self-managed super fund, as well as tying in maybe some investment advice along the way. So that's when you'll probably need the formal advice, and make sure that that advice is coming from a qualified, licensed professional. And it really is a prudent move if you want to be secure in your decision. I mean, after all, self-managed super fund is a financial product. It's a major financial decision in your life. It's your future, so it's good to get it right and be comfortable in the decision that you're making. So next we look at the structure. So once you've decided whether you need the advice or not, we look to the structure. Now, all self-managed super funds have a limit of 4 members. All of these members must be trustees or directors of a corporate trustee. In terms of trustees, you have the choice to have individual trustees, or, as I mentioned, a corporate trustee. So that's a company acting as trustee for you. You cannot have a single individual trustee. If you are the only member of your fund, then you don't really have a choice. You have to put that company in place to act as trustee, and you would then be the director of that company. So let's have a look. For example, John and Mary, they have their own super fund. And we're going to have a look at how would the underlying assets and the name of the fund be structured. So John and Mary are individual trustees, and they have their own super fund. The assets would be in the name of John and Mary Smith as trustee for the Smith Family Super Fund. On the flip side, if they had a corporate trustee, the assets would be in the name of the company as trustee for the Smith Family Super Fund. So this might be something like Smith Super Proprietary Limited. And both John and Mary would be directors of this company. So as you can see, the assets of the super fund are held in the name of the trustees in trust for the super fund. I mean, in our business, I encourage new super funds to incorporate a company to act as trustee for the fund rather than individuals. There's a number of reasons behind this. For me, it comes down to changes in members later on, death of a member, and also reduction in liability are probably the main ones I look at. So let's use John and Mary's situation again and say husband and wife, they're individual trustees of their super fund. But let's also say that John and Mary, unfortunately, are going to get a divorce, and John wants to start his own fund, which is typical of what happens in this circumstance. The trustees at this stage would be forced to put in place a corporate trustee. As we know, self-managed super fund can't have a single individual trustee. So what does that mean for John and Mary? It means that there's an extra cost now. They have to go and purchase a company, put that in place, and it also means that all the underlying assets of that super fund need to be changed from the individual trustees being reported to now the new trustee situation, which is the corporate trustee. So look, this isn't something that can't be done. I do see it happen all the time, but there is paperwork involved, and look, most people don't really want to have to deal with it later on. So I think it's probably a prudent move to have a look at a corporate trustee right at the beginning, then you don't have to deal with any of that later on. So if the same situation occurred and there was a corporate trustee in place for John and Mary, then when John left the fund, he would only be removed as a director of that corporate trustee, and none of the super fund assets would need to be changed because the Smith Super Proprietary Limited company was still there and still the same. This would be the same process on the death of a member also. Now, unfortunately, I've been in the situation with some super funds where one member has passed away and they had individual trustees. And unfortunately, going through the grieving and the emotional stage that they're at, they've had to take a phone call from me saying, look, we need to change the structure of your fund now to make it compliant, and we have to do this cost and paperwork. And it's not something that anyone really wants to have to go through at that stage. So I think, again, if you can avoid that sort of thing, corporate trustee is probably the way to go. So we've got the trustee structure, so whether that's individual or corporate, and once you've chosen that, what we do is we set up the super fund deed. Now, the deed is what I like to call your rule book, and this governs every decision that your fund makes. It's in line with legislation, and so if legislation changes, then the deed would also need to be updated at that point. In our industry, back in 2007 and also 2010, we had larger legislation changes, and that meant that a lot of deeds had to be updated. Luckily, we haven't had any major changes come through for the last 5 years. I don't know if anything's going to be coming down the track. We kind of never know. But if it did, then any deeds that were set up today might have to be updated as well. So at the same time that the fund is being established, relevant registrations with the tax office are then applied for. So that's your tax file number and your ABN are applied for too. So all funds must have an ABN and a tax file number as we're lodging. So we lodge tax returns, and that's their identification numbers. If you are getting your fund set up through an accountant or an advisor, it's probably good to have one that has a tax agent involved, therefore they can do that all sort of in-house at the same time for you. Now, once that structure is pretty much set up and we've applied for the registrations, we look to set up a bank account. Now, the bank account is where rollovers from your retail or industry funds that you currently have will roll over into there. And then from then, once the money's in there, you can start making investment decisions. Now, before those investment decisions are made, we probably need to look at the investment strategy. So if we take the analogy that the deed is your rule book, then I'd suggest that the investment strategy is the roadmap to your fund. As trustees, you have to be able to articulate how you're going to handle certain things like liquidity and risk, diversification, contributions, pensions, insurance, and the type of investments you want to hold in your fund, and probably more importantly, why. You need to know why you have a fund and why you want certain investments to be there. The ATO put quite a bit of focus on this document because it demonstrates a trustee's understanding of the fund. Now, the investment strategy is something that can be prepared by trustees themselves. You have the ability to do it yourself if you want, or you can outsource that to a professional like our firm. We would do that for a lot of trustees if they wanted us to. The link that I've got at the bottom of the slide there to the ATO is a great reference tool for new trustees to understand what's involved in setting up a fund. On our website, also at superfunpartners.com.au, we have a dedicated page to set up, and it goes through a bit of a checklist and things to consider for potential trustees. I'll make a side note to this. The ATO have, over the last couple of years, really expanded their SMSF educational information on their website. I'd really encourage you all to have a look at some of the videos that they put up. They're quite informative, but they're also quite creative too, which is a novelty for government bodies, but nonetheless, they're good value. Okay, the roles and responsibilities. So this is maybe the scary stuff. No, it's not really scary, but it is important to know what your role is as trustee and the responsibilities that you do have. I think a lot of the points noted on the slide are what I would suggest are common sense, but nevertheless, I thought I'd reiterate them again. So things like acting honestly, act in the best interest of the members, be responsible for the control over the fund, retaining relevant documents. And I think the main one that catches people out sometimes are the caps or limits and fundamental rules. So when we talk about caps or limits, sometimes they're referring to contribution caps. So if we look at employer, or what's known as concessional contributions, if you're under 50, you have the ability to put in $30,000 per year. If you're over 50, you have a limit of $35,000 a year. Non-concessional money, or after-tax dollars, you have a limit of $180,000 per year, or you can bring forward what's known as the bring forward rule, where you can bring forward 3 years worth of those sorts of contributions. So it'll be $540,000. So don't get too caught up in the numbers that I've just thrown out at you. We are going to go through a bit more of that in the e-workshop that we're going to do on the 19th, and we can go through the different limits and how they will apply to different situations. Now, there is plenty of information out there on what the contribution limits are and also basic rules of the fund. In our business, we do see education as a crucial factor in maintaining compliant funds. So if you do go ahead with setting up a fund, then really think about getting an advisor or an administrator that provides this sort of support for you. I think it's going to really make a huge difference to your experience and how the fund runs. So the next point we talk about is the sole purpose test. This in layman's terms means, why do you have a fund? If you would answer this question as the ability to take out money to prop up your business, then I'm going to suggest you shouldn't have a fund. You're going to get into a lot of trouble and it's going to be a lot of heartache for you. If you answer to provide benefits for your retirement or your beneficiaries, then you'd be 100% correct. A little while ago, the ATO did cold calling, asking trustees if they knew what the sole purpose test was. It didn't go down too well. They've kind of changed their tactic now along with their new educational videos and information, and at the beginning of setups they're contacting clients and asking, when did you set up the fund, who is the trustee, why did you set up the super fund, how much are the rollovers that are coming into your fund, to try and gauge that trustees actually have an understanding of what's going on. So they are placing a lot of importance on that. So be clear on why you have a fund, and please don't use it as a vehicle other than what it's meant for, which is your retirement basically. My last point about responsibility is ignorance is not an excuse. The ATO are not going to care if you say you didn't know. If there is a breach of the rules within the fund, they're not going to come directly to your administrator, accountant, or me. They're going to ask the trustees the questions. So this again harps back to making sure that you've got a support team that firstly provides education around the rules, but also has processes that can mitigate any sort of breaches. So when I say processes, I mean up-to-date accounts, doing them maybe on a monthly basis so that you can track what's happening within your fund, and if there is an accidental breach, that it can be resolved or remedied pretty quickly. That goes a long way in the ATO's eyes if a breach does occur. So those sorts of things are what to look for. So look, none of this is meant to scare anybody about the roles or responsibilities, but it is a serious role that does need to be understood. Okay, costs. This is sometimes the determining factor on whether someone starts a fund or not, and to be honest, it's a really valid point. It's not a cheap exercise to do, and neither should it be. It's a major financial structure that's put in place that involves legal documents, minutes, declarations, ATO registrations, ASICs involved, and then we have the ongoing costs, and these all do add up. So the setup costs, or the initial costs, can be anywhere from $1,500 to $4,000, and this is usually dependent upon whether advice for the structure is involved. The ongoing costs, are broken down into quite a few different areas, and we look at administration costs, so that's your financial statements that are prepared. Tax returns, as I said, super funds have to lodge a tax return every year, so there's a cost involved with that. Audit, regulations state that all self-managed super funds have to be independently audited. The supervisory levy, this is an ATO levy. At the moment it's around $388. You can't get around it. The ATO apply it, so you need to consider that too. There's ASIC, so that will come into play if you go down the corporate trustee route. Usually it's around $47 for that. The actuarial certificate, now this is in play if people are running both accumulation and pension accounts. Again, that's maybe a little bit too much for today's webinar. We're going to go through a bit more of that structural stuff in the e-workshop, the difference between an accumulation and a pension account and what that means. But basically an actuarial certificate will provide a tax-free percentage of the fund. And then there's insurance. Self-managed super funds have the ability to have their own insurance in there for members. So that's life cover. So you need to consider that also. Now, the prices for these sorts of things fluctuate from business to business. I've seen accounting and administration costs range from $800 to $8,000. Now, look, I think both these figures are maybe a little bit inappropriate for the work that's involved, so I'd suggest maybe 800 is a little bit too light, 8,000 maybe a little bit too much. I probably see the average range around the $1,500 to $3,500 mark, depending on what type of investments you do have. And on that, I will note that be very careful of low-cost service providers. There's a few out there at the moment, and ASIC have had them in their sites. Some have been shut down and directors have been penalised. You know, things spruiking no-fee setups and really low ongoing administration. They're being closely monitored, so just make sure who you're getting involved with in that. Now, some things like the actuarial certificates that I spoke about are usually pretty stock standard across the board, but the administration of fund is one area where I quite often see large differences. And I guess these costs can be daunting sometimes, but they have to be weighted against the opportunity that a self-managed super fund is going to provide you that's different to what a retail or industry fund can afford you. So I guess your job as trustee is to really find the value in the money that you're spending. And if you can do that, then I think you've made a great investment for your future. Now, the fees that we discussed, and no matter what business you go to, they should always be transparent. So know what you're paying for and what you'll be getting in returns. Have a good expectation of what you're going to be getting for the fees that you're paying. Understand the add-ons for extra work. Some people bundle them all together. Some businesses charge extra for smaller things along the way. And also make sure that you're provided with some type of service agreement so that you also know what to expect from year to year. Now, as for the investment costs, these can come in the form of advice to purchase certain assets, and they can also be the costs involved in holding the investments themselves. Things such as brokerage with shares, account fees for managed funds, bank fees for your cash accounts, or advisor review fees if you have certain portfolios. Then you have your strategic costs. Now, these usually come with formal advice, and they aim to better position your fund financially, basically. So they can be strategic advice around pensions or contributions. They can be investment structures. And again, we're going to go into a bit more in depth in the e-workshop about the different strategic reviews that we can do. But the main message around costs is to really understand the pricing structure of the business or businesses that you're dealing with, and to be comfortable with the level of value you can expect. The last point I have on that slide is comparisons. Now, when it's quite easy to compare between self-managed super fund to self-managed super fund, you know, with different businesses that you're dealing with. It's a little bit harder to deal or to have a look at industry or retail funds compared to self-managed super funds. So if that's something that you really want to do, then you are probably going to have to go down the investment or the advice route to be able to see exactly what's going on, because generally some of the retail and industry funds will have more of the hidden costs that you don't always see on your statements. Okay, investment choices. This is the fun stuff, and it's really the guts of why most people want a fund in the first place. It's that control factor. You may be the type of person that knows exactly what they want to do, be very self-directed, and you're happy to do it yourself. Or you might be someone that wants an advisor to step in and make recommendations for you and put a plan in place, and both of those are fine. You may be a bit of a mixture of both. I see a lot of this happen now, is that most people like to take control and they seek advice when they feel they need it. And I think this is down to having a lot of general advice and education out there for people to make informed decisions. And then when they feel like the general advice doesn't take it to the level that they need, they seek professional advice then too. So I guess that's the beauty about self-managed super funds, is that they can cater to most people's preferences. So if we have a look at the types of investments that you can have. Obviously cash, shares, both international and Australian, managed funds. You've got property, now that's direct properties, that can be residential or commercial properties, and that can be with borrowing or without borrowing. You've got fixed interest, so that could be in terms of term deposits or bonds. Annuities, that's more like an income stream, or collectibles. Now collectibles are a bit of a funny beast. They really need to be considered closely if you are going to have them in your super fund, and making sure that the value that you hope they appreciate to is for your retirement, and there's a lot more restrictions around collectibles as well, so be very careful of that if you are considering collectibles. Now the list seems to be a bit of an open slather and much more flexible than a retail or industry fund, but there are restrictions with the investments within your own fund. The main ones that I see with Superfund assets, they come down to personal use. So if we refer back to the sole purpose test that we discussed earlier, you'd probably suggest that buying a residential property and then living in it yourself would be using the asset to build wouldn't be using the asset to build retirement wealth. It'd be you using it now and benefiting from it now. Hence why, if you have a residential property within your fund, you can't use it, and neither can any related party. You also can't lend money from your fund to a related party or another member, and you can't purchase assets from a related party unless they are shares or commercial property. Again, we're going to go through this in the e-workshop, or if you do want to know a little bit more about this in depth, please feel free to email me or we can discuss it. And I guess at the end of the day, your investment choices really need to be in line with your risk tolerance, and that ties back to your investment strategy. Why do you have these investments and what do you hope to get out of them? And are they in the right risk range for you? Common breaches. The most common breach that I see, well, there's two of them, and it's not holding the assets in the correct name. So as we discussed at the beginning, trustee name, and also withdrawing money for personal use before meeting your pension age. While the name change for assets is a relatively small breach and it can be easily remedied, the early access to funds is a much bigger deal, and that can carry hefty penalties to the trustees personally. So the ATO have put a penalty regime in place, and they fine the trustees personally for each breach, and this can be up to $10,800 each. There was a current case that just came out where there was loan to members from a super fund to prop up a failing business, and they took out only smaller amounts, like it wasn't thousands upon thousands, but they did it over a 3-year period, and consequently the fund was made non-compliant, they lost their fund, and they were also fined individually, and I think it was upwards of $40,000 for that. So good lesson not to get into any situation like that. Strategies. Okay, so this builds on the investments that you choose, and look, the different investment strategies that you can have we'll probably go through in a bit more depth in the e-workshop again, but the current strategies that most people will utilise are borrowing. That's been a big one for the self-managed super fund space, in allowing a super fund to borrow to purchase a property. There are quite a number of restrictions around it. It's not right for everybody. However, if you do meet the criteria, it can be a wealth creation vehicle for you. Business property and self-managed super fund. I recently wrote an article on this and how the transfer of business commercial property into a super fund can benefit both the super fund and outside of super fund, so their entire wealth creation can be boosted. We have salary sacrifice. Most people will know what that is. That's extra super basically being put into your super fund before tax from your employer. And a strategy that sometimes ties into this is called a transition to retirement pension. This is available to people who, if you're born before 1960, would be 55. So pretty much from 55 upwards, you would generally have the ability to utilise a transition to retirement pension in which you could withdraw a minimum of 4% and a maximum of 10% of your benefits. So start getting some of that money out of super and utilising it. Structured in the right way can have tax effective consequences both personally and within the fund. But again, it's an advice area that needs to be considered, and you would probably need to go and see a specialist regarding this. We've got CGT, small business rollovers. So for some people that have had small business sales, there is a way of being able to contribute larger amounts into super that don't go against the normal contribution caps that we spoke about earlier. Again, there's certain criteria that you have to meet for that, but definitely a strategy that can be utilised for a lot of small businesses. Reducing death tax, whilst not a great subject to really talk about, unfortunately it is something that we have to deal with, and there are ways to mitigate paying larger amounts of death tax to your beneficiaries, so we can look at ways in structuring it so that it reduces that. And the last strategy that I'll talk about is anti-detriment. Not a lot of people are doing these strategies. Our firm is just started doing a lot more of them, only because of the intergenerational benefits that it has, and being able to provide hefty tax losses going forward for children, grandchildren, and it's a really tax-saving environment to be in. So those are the type of strategies that we utilise a lot, and we will go in depth a bit more in the e-workshop. But if you did want to talk about them and not do the e-workshop, then I am running a 30-minute free consultation that all registers today can take advantage of, and we can have more of a one-on-one conversation if you would prefer. So on that note, I'm going to pass back over to Caitlin, who will facilitate questions.
Thanks, Chloe, for an informative presentation, which has helped separate fact from fiction and answered the question, is a self-managed super fund really self-managed? It is now time for our Q&A session, so please send through your questions for Chloe using the text box on screen, and we will answer as many as we can in the remaining minutes. I've already had a few come through. I really want to buy property in my super fund. Can this be my only asset, or do I have to buy shares and manage funds?
The simple answer to that is yes, property's fine, and it's fine to have that being your only asset. I guess if I'm to put my advisor hat on, I would say, well, we probably need to look at two areas of diversification for, investment risk, and we also need to look at liquidity. Generally, when you have just one asset in the fund and it being what we like to call a lumpy asset, which is the property, it's harder to be able to get cash flow to be able to pay expenses, or when you're in pension phase, to be able to withdraw to meet your minimums. So that would be a consideration along the way. But essentially, yes, you can just have a property, but I would be looking at all the areas within your investment strategy to make sure that that meets it.
Thanks, Chloe. What happens if I set up a fund and then travel overseas for a short period?
So travelling overseas for a short period is fine. What we look at in terms of the legislation is the central management and control of a super fund. Now that needs to be within Australia. So if you're just doing a short trip overseas, there's no issue with that. However, if your intention is to stay overseas, say for 2 years or beyond, or you don't have any intention of coming back for quite a while, then you would need to look at either sort of shutting down the fund or putting in an enduring power of attorney to act as your trustee while you're away. Now there's certain rules about what you can and can't do while you are out of the country if you do have an enduring power of attorney in place, but definitely there's ways around that. So if you are going for a short time, that's fine. If you're going for longer, there's also ways around it too.
Thanks, Chloe. Can I do the administration myself or do I need an accountant?
It's funny, I get this asked quite a bit, and sometimes it has to do with the, cost of preparing the accounts. But what goes into setting up funds and doing the administration on an individual basis, I don't think the time or cost would the time and cost is not going to outweigh the benefit that you get. You would have to have specialist software. You would need to know how to construct a tax return. And then also, once you'd finish that, you would have to find a tax agent who was able to lodge for you, as well as getting an independent auditor. So although strictly it's not a no, it's not really often done, and it's probably more efficient to get an administrator, a specialist looking after your accounts, so that you as trustee can spend time on the more important things like making investment decisions and growing your fund for your retirement.
Thanks, Chloe. Are there any negatives of the corporate trustee option compared to the other option that we need to be aware of?
Not really. The only thing to consider really is that cost. So as individual trustees, you obviously don't have to report to ASIC or have the company in place, whereas if you do have a corporate trustee, you are going to have the annual ASIC registration fee, and there may also be a fee for an administration house to look after your register or act as your registered agent for the company. As directors, you're more than capable of doing that yourselves. There's not a hell of a lot involved with it, but small costs. But other than that, that's essentially it.
Thanks, Chloe. Are the costs of managing the fund tax deductible?
Yes, generally the administration costs are. So it comes down to how they're broken up, whether it's initial advice, no, ongoing administration, yes. So they are tax deductible to the fund and they can be paid out of the fund's balance.
Thanks, Chloe. Got another one here. How much does it cost for your company to administer a fund that has only cash and shares only 2 members and a corporate trustee?
On that basis, you're probably going to be looking at around the 1620 mark. That's our base sort of rate for that. There's no sort of extra for a huge share portfolio or a small share portfolio, and a lot of our stuff does come down to data feeding. Our processes and the way that we work is that we utilize platforms that are able to provide the information from share trading platforms on an electronic basis, which means it's 100% correct. And it's also efficient as well. So from the basic administration costs, yes, it would be around the 1620 mark.
Thanks, Chloe. Is there a threshold of how much money you should have in a super fund before moving to a self-managed super fund?
As I noted at the beginning, although ASIC do say that anything under $200,000 you should have advice, that's not to say that it means that you shouldn't have a fund at all. I see plenty of funds that have under that $200,000 mark, but they have an investment portfolio that maybe is going to grow and see that amount grow pretty quickly, or they may have a more aggressive portfolio, or they're fine with the way that the fees are at that point. It doesn't mean you shouldn't have it, but it is a consideration, as I said, that economies of scale and the percentage of expenses compared to the value of the fund.
Thanks, Chloe. Who pays death taxes? I don't understand. How can I avoid this?
Death taxes is one of those things that not a lot of people are aware of. And frankly, when you have passed, I bet you're not thinking about it then either. But it is a consideration for your beneficiaries. So it's a little bit technical, and we can go through it in a bit more depth in the e-workshop or via a direct email. But essentially, Your member component is made up of tax-free and a taxable component. So on the passing, your taxable component of your members' benefit goes to your beneficiaries and it is taxed on the way out. So if it goes straight to your estate, there's 15% tax. If it goes straight to your beneficiary, then it's 15% plus Medicare levy. So in terms of larger funds that have $500,000 of a taxable component, we're talking a large sum of tax that goes straight to the ATO and bypasses your beneficiaries. And for a lot of people that have worked hard all their lives and have paid their dues to the tax office, this is a huge consideration, and therefore the strategy to try and reduce that taxable component of a member's balance can be a big deal for some trustees.
Thanks, Chloe. If the trust has a corporate trustee, does the company have to pay tax, 30%, on end of financial year profit?
No, the company is not a trading entity. It's what we call a sole purpose corporate trustee. Its only job is to act as trustee for the super fund. It holds no registrations, it lodges no tax returns, and there is no financial flow through there like a normal company. Everything is situated through the super fund, and the tax rate is at 15% through the super fund, and that is the lodging entity.
Thanks, Chloe. Are the costs of setup deductible, and if a trustee paid to set it up, can I claim it back from the fund?
Yes, we see that happen a lot because time and time again you will set up a fund and the rollovers, as we talked about, the money wouldn't have gone into the fund yet. So a lot of people will pay for the setup themselves and then the super fund will reimburse them as soon as practicable, and that's a standard practice across the board.
Thanks, Chloe. Are there different requirements for super funds between states?
No, it's national legislation. So if you have a super fund in Queensland, it's the same as having a super fund in New South Wales. The only issue that you will come across really in terms of state law is if you have a property, and that comes down to title searches and conveyancing and things like that, that you might find a differing in costs. But as for the administration and the way that it functions, no, it's governed by national law.
Thanks, Chloe. Is it advisable for husband and wife to join their super and have a joint self-managed super fund?
Whilst I can't advise on what is best for each person, I will say that I see that's probably the most common structure, is having a husband and wife join their super fund balances together. Again, as we said before, the economies of scale are in place. So if you have two lots of superannuation monies coming together, then that's obviously going to make that expense percentage lower. Then again, I have seen people with blended families and second marriages that they have two separate super funds and they keep things very separate from an estate planning point of view. It's a very individual thing on whether you would have spouse set up fund together or whether they would have individual ones, and that would have to be looked at in its entirety in their personal circumstance.
Thanks, Chloe. What if your investments lose value or money? Are there penalties for being a poor investor?
No penalties for being a poor investor. I guess the only thing to consider with that is the market value of your investments is looked at on 30 June every year. And the thing that really affects that is if you're in pension phase. The pensions calculations are derived from the market value of the underlying assets. So when we had the GFC happen, that's why you saw a lot of trustees that were going into pension phase panicking because their investments had lost quite a bit of money, and that directly affected the amount that they had to pull out. In terms of penalties for losing money, no, there's no penalties for that at all.
Thanks, Chloe. Are you able to explain anti-detriment you spoke about earlier, or will that be covered in the next workshop?
I'm going to cover off on that in the next workshop. It's probably one of the most complex strategies that you can have within a self-managed super fund. And as I said, not a lot of people out there are doing it. Essentially, it provides an ongoing tax loss to your family members who come into the fund later, who may be in accumulation phase. Now, I know this sounds very technical, and it is, but I am going to run through a scenario in the e-workshop, or if you aren't able to make the e-workshop, I can provide you with some general advice on it via email or Skype.
Thanks, Chloe. What if I want to live in Europe permanently and retire?
I would say a self-managed super fund is not going to be great for you. In that way, the central management and control of your super fund is no longer in Australia, and that means that you don't meet a complying super fund status. So I'd be looking at ways to, if you had retired, what you would do with that money. And essentially, if you have retired and you're over 60, then you're able to pull out your money tax-free and do with it what you will. So that would probably be a consideration.
Thanks, Chloe. That's all the time we have questions for today. We've had a couple of inquiries on how to contact Chloe, and her details are up on screen if you want to get in touch with her. On behalf of CCRQ, I'd like to thank Chloe from Superfund Partners for taking the time to present today. I'd also like to thank everyone who has joined us for today's session. If you have any further questions for Chloe, you can contact her with the information that's on screen. And if you're interested in taking the next step in self-managed super funds, Chloe and Superfund Partners will also be doing the workshop on the 19th of October, where you'll be taken through the self-managed super fund options in more detail and walk away with an actual plan on what the best option is for you. Places are limited, so you can go to the CCRQ events page to secure your place for that e-workshop. Don't forget that CCRQ has a range of webinars and events coming up over the next week or so, including Less Tax, More Gain, a business owner's guide to small business CGT concessions on the 12th of October, and Workplace Injuries, Prevention, Management and Stay at Work on the 13th of October. If you want to find out more about the upcoming webinars, go to the CCRQ events page to book your place. Thanks for joining us today. My name is Caitlin Mutzelberg from CCRQ, and I look forward to welcoming you to another CCRQ webinar in the very near future.